Welcome to another edition of Around the Table with Stacy Smith as we take a look at the economy and investing. Dare I say it, that after the close on Friday, the Dow is now only 552 points or 1.5% away from setting a new all-time high. And the S&P 500 is only 4% or only 193 points away from reaching a new all-time high. It has been a remarkable rally in 2023 compared to where things stood at this time last year. However, in the same year, bond yields skyrocketed to heights that have not been seen in more than a decade. And as those yields climbed higher, bonds and interest-bearing accounts like money markets have become very attractive. So is now the time to try to plot some new strategies? Well, that is one of the topics that we're going to have today and Around the Table with Stacy Smith. And I'd like to introduce you to our panel of analysts and financial advisors. First up is Carrie Coghill. Carrie is the president and CEO of Coghill Investment Strategies, which is headquartered here in Pittsburgh. Carrie has been recognized by Forbes as one of the top women wealth advisors in the country. Also seated at the table is Frank Rossetti. Frank is the managing director of HF Management Company, which is part of an alternative asset partnership. Now, Frank's background includes 50 years in the investing field, and he helped to establish Harvest Financial here in Pittsburgh, where he was the executive chairman. Across the table, we find Kim Forrest. Kim is the chief investment officer and the founder of Boca Capital Partners. Kim has a dual background in both finance and in software engineering, and you may have seen Kim in her many appearances on Bloomberg, on Fox Business, and also on CNBC. There is one more seat at the table, and that is where we find Michael Godwin with Fregasso Advisors. Michael has a solid career in investing and is the chief investment officer for Fregasso Financial Advisors. And again this year, Fregasso Advisors is listed among the Barron's National Top 100 Independent Advisors. I want to thank all of you once again for joining me for Around the Table. We've had some great discussions throughout the year, and I hope to see another great one today. Now, as I mentioned, as the Fed kept raising interest rates, interest in bonds, investing in bonds or money markets became attractive. Many people invested in money market funds that pay around 5%, which sounds good after the S&P 500 tumbled 18% in 2022. But 2023 is a completely different story. And Carrie, you say that it is time now to rethink that money market strategy.
Yeah, I think what we're finding is that people are being complacent about how they're investing their money because they can go to the bank and not really even the bank, but they can invest at Fidelity in a money market fund, for example, and earn 5%. And what they're neglecting to realize is that when you invest in something that has no risk or virtually no risk, basically, that is designed to potentially try to keep your purchasing power at the same rate of inflation. So in essence, you're really not earning any money because whatever you're earning, when you go to spend that money, you're going to buy something that's also, the price has gone up by 5%. So what people really need to be mindful of is that investing in a money market fund is not an investment. As we see rates come down, we will start to see those yields on money market funds come down. And it's a great opportunity to really look at your overall asset allocation, because if that's what you believe, that inflation will continue to come down, at least look at some other alternatives. One potential alternative is to invest in a bond or a bond fund that will, as interest rates come down, those funds are designed so that they can see actual appreciation with the bond. Now, we have had over the course of the last 6 weeks a significant rally in bonds. I'm not quite sure what the up-to-date number is, but I think it's over 4%, which is the greatest amount that we've seen since the 1980s. So those people that owned bonds and owned bond funds, during the last 18 months when prices went down, they're starting to reap the benefit of having a diversified portfolio.
That being said, the rise in bond prices has taken away a lot of the edge of that. I mean, the long-term treasury bonds are in the low 4%. And quite frankly, that's probably not a good enough rate of return to make them very attractive. I wonder, as this week rolls out and we have a Fed auction, if the demand will cause these rates to rise. The problem is when the bond market moves, the interest rates will go from, to make it up, 4.25 to 4.3, and that's considered a big move. And this is why bonds are a balancing factor for portfolios. If you run a mixed portfolio, a blended portfolio of stocks and bonds typically, 2022 aside, don't move that much. Of course, in 2022, they've acted like stocks.
Go ahead, Michael.
Oh, thanks. The one thing I would add is if you do have a bit of cash on the sidelines, which we have clients that have a decent amount of money at their PNC accounts or whatever their bank account is, they are still paying pennies on the dollar in terms of interest rates. In that instance, we have been taking that and moving them into money market funds where you're at least getting something for the cash that you have on the sidelines. Now, again, you can access that cash maybe a day later than you can in your typical checking or savings account, but the amount that you can earn in, as Carrie mentioned, essentially risk-free yield is significant enough to start thinking about that, taking some cash out of your checking and savings accounts and moving it into a money market fund while it's still paying a decent amount of yield or interest.
I'd like to go back to something you were talking about, Carrie, if I can, just for a moment. And that is when we're talking about money market funds and we're talking about bonds, where should people be going into bonds at this point? I mean, with a money market fund, you're just being paid basically interest on what your money is sitting in there, right? But with the bond, you have a potential of seeing the bond price go up as the rates come down. Am I correct?
That's correct. So, it's a great question. And when you look at investing, what we're doing with portfolios is it's a process called portfolio optimization, which basically takes different exposures to the bond market and to the stock market. And we understand the correlation between how bonds react, how stocks react under various economic circumstances. So that doesn't ever change. We know that when inflation goes up, we know what happens with interest rates. And it's just it's a way for us to try to create as much predictability in an unpredictable market. So at our firm, we don't use alternative investments. Sorry, Frank, that's a part of your world. But it's because our clients are striving for predictability in things that are completely unpredictable. And the only way that we can deliver on that is to understand the correlation and the connection between different asset classes, how they respond to each other and how they respond under different economic circumstances. So if someone does not want all of their money invested in stocks, and some people do, and that's fine, they understand the risk, then we are going to use the bond market. And topic for another day, but there's a lot of different types of bonds out there that we can use. So, I say the same thing about the bond market as I say about the stock market. There's never a bad time. You just have to understand what you're buying in terms of quality and the maturity and everything else.
Can I ask this very quickly question, and we have to take a break, and I'm really sorry, Kim, but the question I have is if you invest in a bond fund, if bond prices go up, the fund price goes up, and if the yield goes up, which this is tough for people to understand, but when the yield goes up, the price of the bond goes down. So if that happens, do you start to lose money with the bond fund?
Yes.
Okay.
Yes. But, you have to, for investors that are investing over periods of time, it's just like the stock market. These things ebb and flow.
And are you paid the interest in a bond fund that with whatever bonds they happen to buy?
Yeah, the underlying.
Yeah, right. Okay, good.
And real quick, let's talk really quick about what a money market is. It is investing in very short-term bonds. So that is typically 9 months or less is the expiration of the bond. So that's how they can, whenever bond yields went up, money markets responded because that short-term bond was going, was paying more interest. And I just wanted to let's rip off the Band-Aid there. You are investing in bonds in money market funds.
But you're more liquid with those.
Yes, because of the shorter time period.
Right. Okay. All right. We have to take a break. We'll be back in just a moment. Welcome back to Around the Table with Stacy Smith as we take a look at the economy and investing. The Fed will hold its last meeting of 2023 this week, and most believe the Fed will do nothing about interest rates. So, Michael, if the Fed does do nothing, will that have an impact on this recent surge upward in the markets that we've seen?
I don't really think so, Stacy. I mean, I looked this morning and the market is currently pricing in a 1.2% chance of a rate hike this week. So it's largely baked in that the Fed will be on hold for this month. I do think that the market cares far more about what Chairman Powell's press conference on Wednesday, what he talks about there, and what he says regarding his belief on the future path of interest rates. So far, the Fed has been pretty adamant about keeping interest rates higher for longer and not looking to cut anytime soon. And I don't think that the market is taking them at their word, because currently the market is expecting the Fed to cut interest rates 4 times next year. So as of now, I think the Fed is on the right path in accomplishing its goal of getting inflation closer to that 2%. Okay, I think inflation last reading was at 4% right now, and every month this year has seen lower inflation readings than the preceding one. So that's good news. But in regards to the markets, I think when you think about this logically, and as a side note, I don't think you really should rely on logic when investing, because what you may think is logical, the markets will often disagree with you. But nevertheless, I think we're very close, as you mentioned earlier, Stacy, to hitting all-time highs set back in January of 2022 in the stock market. And one of the biggest reasons why the market did so well from the March 2020 lows through the end of 2021 was because interest rates were near 0% and money was cheap. Now we know that interest rates are no longer at 0 and money isn't cheap, and the markets have essentially shrugged that off over the course of 2023. And I think that's because the consumer still remains very strong and unemployment is still historically low. So all in, I think the Fed will be very important to pay attention to in 2024, but there's going to be a lot of other factors at play as well. And I think interest rates are going to be a big component of that in as we move into the new year.
So I always ask, why do we focus on interest rates and inflation together? And I don't know that why. Well, let me start again. Interest rates should make the economy move slower because, as Michael just pointed out, when we had zero interest rate, it made money cheap, and you could invest in things, start a new, borrow money to do something new as a company. And, with higher interest rates, it makes everybody be more thoughtful about the money they're borrowing. Now, I'm not sure that that has anything to do with the price of toothpaste or milk or, that kind of stuff. And what I do know is that the amount of money supply, how many dollars are out there, really does have something to do with it. And if you are a nerd like me and you watch the Fed M2 estimate come down month after month, there's a correlation between falling inflation and money supply. So that's what I'm looking at, looking into 2024, trying to decide, will the Fed need to do that? Because, inflation is coming under control, probably because we don't have too many dollars chasing too few goods anymore, because we have fewer dollars, and it looks like we've more or less conquered the supply chain issues that we had over the last couple of years. So looking at that kind of gives even more thought to what you should do with your money, and not to just rely on what the Fed says and interest rates.
It's funny, last week I heard a term, it's the first time I've heard this, because we've talked about, is this going to be a hard landing or a soft landing? And what I heard was no landing. We're not going to have a landing. And maybe that's true. Maybe this is just a continuation of an expansion that was somewhat unusual because of COVID. because of all of the money that was created, because of all of the disruptions. When we look at economic data every week, there are some things that are suggesting, inflation's coming down. There's some things that are also suggesting that, the economy's continuing to grow. The consumer's confidence is actually a little bit better than it had been. So sometimes we get so wrapped up in what's going to happen next that we neglect to actually look at what's actually happening right now.
You folks are starting to sound like me. The the economy has been good because we had pent-up demand created by COVID partially. It's been good because of stimulus partially. It's been good because we're onshoring things, which means we're building factories, which is creating jobs partially. It's been good because there's been a lot of money thrown around for all sorts of things, and that has only just begun. The infrastructure bill has yet to start delivering cash, and the CHIPS bill is just starting as we speak. And these things are incredibly stimulative, and we'll find out in January and see how retail sales are to see if they keep moving along as they have been. But I don't think by any means we could expect a hot economy. I just think it's going to keep moving along. And the reason I don't think it'll be hot is our population is somewhat static. It's growing largely because we who are elderly continue to work and continue to consume. And we keep adding to the population because we're still here. Whereas years ago, we would have passed on to whatever's next. That being said, I'm not overly concerned about the stock market from a long-term perspective. We'll have corrections. Naturally, we'll have corrections. Something will happen in the Middle East or with the Arabian oil supply or our oil supply or politics or whatever that will cause the market to pull back. And that, to me, will just be a buying opportunity because I'm firmly convinced that the U.S. economy is going to grow slowly over time.
All right, we have to take a break. I'm not quite sure who you were referring to when you say we who are older, Frank, but anyway, we'll be back in just a moment. Welcome back to Around the Table with Stacy Smith as we take a look at investing in the economy. Some investors believe the Fed will begin to lower interest rates sometime in 2024 and perhaps as early as in March. So, Frank, given that the markets move up or down and anticipating how things are going to be, how should the markets react whenever the Fed does decide to lower interest rates?
Well, if the reason the markets are moving today remain, which is this Goldilocks economy, the belief that interest rates are going to drop some number of times next year, and if that stuff stays in place, the market isn't going to do anything when they finally drop interest rates because it will be highly anticipated. The wild card is, which is probably the more likely event, is why they will drop interest rates. I see no reason, considering what I believe is happening out there, for interest rates to go down or up. I think they're probably right where they ought to be for now. Now, if we start sliding into a recession, which will, again, someday we'll have a recession again, and that someday may be in 2024, who knows, certainly not me. We could see interest rates being dropped to stimulate the economy as opposed to we don't have to worry about inflation anymore. If that is the case, the market will probably go down. But who knows what the case will be when they finally do it. I think they will stay where they are, not higher, stay where they are for longer than people are anticipating. And the reason is I don't see this economy weakening either. So if I'm right, the market will just ignore all these things whenever they do happen because they will be highly anticipated.
You guys agree with that?
We think mainly about interest rates, about our economy, the U.S. economy, which is a global economy. Even a lot of the smaller stocks that might be in your portfolio probably have significant amounts of business in China or Europe. Those are the two other major areas where interest rates matter. And they matter because, as we saw in, I'm trying to remember now, I think it's 2022, it seems so long ago, 2022, when Europe was on sale. And it's because our dollar was so strong because we had raised interest rates, and that had all these dollars flooding in from people who wanted to buy our bonds from Europe and China. Okay. So when I think about where should the US interest rate be, I can't just look at our economy. I have to look at what's happening in China, which is a hot mess with respect to borrowing. They don't have really good controls on local governments borrowing, and that has been a driver of their economy, was local governments. And by that, I mean like provinces and large cities borrowing to build actual buildings and infrastructure. And then now the chickens are coming home to roost. So that could be a place that has a crisis that drives everybody's interest rates lower. And Europe doesn't seem all that particularly well positioned with respect to its economy. There's many reasons, and I'm not going to go on and on about that, but these are areas that you have to watch when you're thinking about, is the US going to lower its interest rates because of forces outside of its borders?
Well, to play off of what you're just talking about there, Kim, in Bloomberg this morning, it was, I'm going to quote here, it's a bumper week for central banks with the Fed, the ECB, and the BOE, that would be the European Central Bank and the Bank of England, holding their policy meetings. The key question central banks face is whether coming inflation readings will allow them to pivot quickly enough to blunt the impact of their past tightening and head off what this hard landing we're talking about, which Carrie just mentioned, also could just be a no landing. So I just thought I'd throw that one out there for you guys.
Yep.
I would say, back to Frank's comment, Stacy, and what you kind of mentioned there before, is it depends on the reason why the Fed would need to cut. Okay, if they need to cut because jobless claims are starting to go up, and they're worried about the economy, certain types of stocks are going to do better than others. I mentioned before, you want to own consumer staples, you want to own utility stocks, you want to own the defensive proxies. However, if inflation comes back down and the economy is still just chugging along pretty well, you have a scenario where the Fed has interest rates at 5.5% and inflation is at 2%. That means your real interest rate is about 3.5%. That's generally pretty high over the past decade in terms of what your real rate wants to be. And at that point, the Fed's going to probably look to cut interest rates a little bit more because they're being a little bit too restrictive. In that scenario, back to what Kim said before, tech stocks are likely to do pretty well, financials could do kind of well, and some sort of high beta names are going to do well also. So it really is going to depend as we go into 2024 on the reason or the impetus why the Fed begins to cutting rates. And I think it's one of those two factors will drive that decision.
Yeah, it's interesting, right? Because I can only imagine as a viewer watching what we're saying, your head starts to spin a little bit, where these are people that are trying to make a decision as to whether or not to take money out of a money market and put it in a mutual fund. And here we are talking about this sector and that sector and everything else. And I really think that it lends itself to the value of professional advice, not to self-promote here for all of us, but it is the reality that markets are a lot more complicated. And it also, even to Frank's point about, we just don't know that well-diversified portfolios that are well-managed for the long term have the best ability to achieve success. And what Kim said is so important, that we don't know what's going to happen outside of our borders. And when you look at certain crises that happen, they can happen overnight, where you wake up one day and a country's currency has collapsed. We've seen it happen. So, that's really why professional advice is helpful. And it's important to, properly vet who you're entrusting your money with. And I can't remember if we covered that on a show or not, how to pick an advisor.
We have briefly talked about it, but that's one of on my list that we need to talk about down the road. So we will do that, but not right now. But we have to take a break. We'll be back in just a moment. Welcome back to Around the Table with Stacy Smith as we take a look at the economy and investing. Kim, if rates do indeed come down next year, are there certain sectors, Michael talked about this just a moment ago, are there certain sectors that might benefit more? Or does it hinge on the reason for the rate cuts, such as a recession?
I'm going to say yes. There you go. No, I'm teasing. Of course, I'm just never going to give you a one-word answer. No, I agree wholeheartedly with what Michael was saying before about, well, two things. The reason why the interest rates are dropping, that will also inform who are winners and losers, but also that high beta. And what does beta mean? Beta is the amount with which a company or a stock moves relative to the index that you're comparing it to. So if you have Microsoft or Kimberly-Clark, I'm trying to think of a toilet paper company because they don't move very much, right? So Kimberly-Clark is likely not to move that much because, well, it just doesn't depend on the economy. Its products are sold mostly on, need, and that's what it's supplying. So, but other companies that have future cash flows that you need to discount back using some number, that's usually the 10-year. If the 10-year moves lower, then the multiple with which you can expect to pay for the stock, that's how many times looking at its earnings that you can pay and feel comfortable with it, that will rise, right? So the beta is then the stock should move more if interest rates move, right? So I'm just trying to tie this whole thing together. Microsoft's price movements are more than Kimberly-Clark, the toilet paper and paper towel maker. So higher beta stocks, so that's any kind of growth stock, are going to move more as interest rates drop, and they're probably going to move higher. But other areas, and it might take some thinking about this, companies that borrow a lot will have an opportunity to refinance and not have to pay so much to their creditors. They might benefit. So that could be in, I don't know, some REITs, real estate investment trusts, which is my least favorite category of investing, but we'll go into that at another time. But they may benefit. And also financial firms who tend to borrow on a short-term basis and lend on a longer-term basis. So those falling interest rates would make their short-term borrowing costs lower. So they might benefit as well.
Carrie, is the logic correct here from Kim?
Yeah. I think that, that's something, again, I go back to how complex this can be for individual investors, right? That, they're not doing, as Kim says, the math on these things. And, the math is really important because what we as advisors are trying to do is to allocate money in areas of the market that we think will be treated best next. And that doesn't mean, I know at our firm, someone's overall allocation, whether they're 60-40 or whatever the mix is, that doesn't change. But what does change is, how much exposure do we want to different segments of stocks in different sectors, as Kim was talking about Kimberly-Clark and Microsoft. And as economic conditions change, when is the right time to take our gains, not sell Microsoft, but take our gains and put it into Kimberly-Clark that maybe hasn't performed as well? That kind of rebalancing is what really can, over time, make a person earn more and have less risk.
Yeah, that's I think so key in terms of what we do when we talk about is making tactical changes as opposed to wholesale changes in portfolios. And that's one of the things I've seen clients do in the past on their own, which it sometimes breaks my heart to see everybody sell out completely their portfolios at the wrong time because X, Y, and Z might happen going forward here, as opposed to just becoming a little bit more nimble and making a change that could help your portfolio tactically over the longer haul. But again, I want to go back to the one part on the interest rates here. If the Fed is set on keeping interest rates higher for longer and the market is expecting 4 interest rate cuts over the next year, something's going to give over 2024. And as Kim mentioned before, and I talked about also, the reason why the culmination of that divergence is going to matter the most. Why is the interest rate going to come down? Is it because the economy is doing okay and inflation's come down a bit? The Fed can cut. Good news. Or do you see jobless claims spike up, unemployment spike up? And it's sort of a bad news scenario. So you got to be a little bit more nimble, I think, going into 2024. And as Carrie mentioned, make those tactical changes. Don't sell 60% of your equities and go to cash, but make smart moves to hedge your portfolio risk.
All right, Frank, I'm sorry. I would love to hear from you, but we are now out of time. And so I apologize to you for that. But unfortunately, we've talked all we can talk at this moment. So I just want to say that there's also a lot more to discuss as we talked about here today about your portfolio, and we'll do that in upcoming sessions. I want to again thank Kimberly and Frank and Michael and Carrie for being with us, and I hope that you join us again for the next edition of Around the Table with Stacy Smith.